Well, great. Good morning and good afternoon to everybody. This is Howard Chao doing Insights with my good friend Bill Russo online. We are going to do a podcast about the global mobility markets with Bill as the interviewee. Could be no better interviewee for this subject. Bill has been a regular at our auto and mobility tech events in Bonnie Doon. Will be coming again, or at least online this year in April. So looking forward to having this conversation with Bill. Welcome, Bill.
Thanks, Howard. My pleasure.
So, Bill, maybe we'd start by asking you to give a little background, a quick summary of your storied career in the auto industry and how it's morphed into mobility, and then maybe we can talk a little bit about how you got to China.
Yeah, sure, Howard. I'm not sure how much of a story it is, but I'll be happy to share with you the journey, the long and circuitous journey that got me to my 19 years now in China. I could say I've split my career almost evenly between the U.S. and China now. So I've calibrated. Things that don't make sense to the casual observer start to make sense after a while, and you can start to explain it in the context of how the industry is evolving here and what makes it such an important force for transformation of the global auto industry. I didn't start my career, though, in auto. I actually started my career at IBM, working in their general technology division in Vermont. And that's a factory now owned by Global Foundries, because the chip industry's evolved quite a bit from where it was in the 1980s when I started working at IBM. But it sort of grounded me in the forces that shape the future. The chip industry and the technology sector in general is now intersecting and disintermediating, in a sense, the evolution of the automotive industry in a way that's, I think, has pattern that is relevant to today's auto industry. So I kind of feel like I've come full circle back in observing what happened to IBM over the decade plus that I was there, and what's now happening in the automotive industry. And I'll get to that because it was a hardware-centric business model that IBM had, and it evolved into a services-oriented business. I actually pivoted in 1987 when I moved to Detroit. Still working for IBM, but I pivoted to the services division, general services division, where I was supporting the automotive clients, in particular Chrysler. But my focus was on applying technology to transform the business processes within the product development side of the business. And I actually was hired by Chrysler in 1993 and worked there for 15 years. And it was Chrysler, through a series of moves within that company, I eventually headed the product and business strategy group within Chrysler, working for then CEO Dieter Zetsche. And it was in 2004, 3 and 4, that he asked me to do a study on the future development of the industry and where the growth opportunities would lie. And obviously the team concluded very decisively that was going to be China. But back in 03, 04, China was about the sixth largest market in the world, and was about to surpass Germany in size. Obviously, it's only a few years later, in 2009, that it became the world's largest automotive market, and has been that ever since, and will forever perhaps be that, because it has the highest demand for mobility, the utility that this industry serves. I came to China in 2004, then as head of Chrysler's Northeast Asia business. It was part of Daimler Chrysler, and was responsible for managing the overall portfolio of programs that we were localizing in country, as well as setting up the entities and sales entities within the Northeast Asia region. I did work for Chrysler for the first 4 years that I was in China. I said I've been there 19 years. So obviously the first 4 was only a fraction of that. And for the past 15 years, I've been working as an automotive advisor, consultant, a variety of consulting assignments that I worked in. I headed up the auto practice for 2, one a global and one a local consulting firm. And I actually founded this company in 2017, Automobility, to really tap into this technological discontinuity that we're now observing happening. My intuition told me that China would be the market to accelerate the commercialization of future of mobility technologies. Those are the, obviously the shared mobility, connected mobility, electric mobility, and future autonomous mobility, because of its huge addressable market size, and much more importantly, the experimental nature of the market. It's got far less deeply rooted legacy than the rest of the world, and it has a what's evolved over the 19 years that I've been in China is a very commercially aggressive set of technology-oriented digital ecosystem players who are investing in mobility, as well as less than deeply rooted non-traditional automotive entities that have now deep pockets, and a lot of invested capital in building up an electric and connected and eventually autonomous mobility market. And that's what really kept me there. And I kind of feel like history's proven my point, that China as a market is so critical to the future of this industry that you have no choice but to figure out how to make it work there. And that's what I help my clients do.
That's a terrific introduction, Bill. And it's amazing that you seem to have mapped out your career in uncannily predictive ways about the future. So, I mean, we're returning full circle to semiconductors, for example, in the auto industry. So your background there obviously must have been very helpful to you. When I was living in Shanghai many years ago, China's auto industry was pretty backwards and heavily reliant on global automakers, right? I mean, they just couldn't get away from them. I mean, I guess part of it was they couldn't make the engines by themselves, and they didn't have the technology, and so it was one of the areas where China was just furthest behind in becoming independent and a market force, or global force. Mm-hmm. And then somehow, at some point in the not too distant past, it flipped, and I think it had to do electrification in EVs. But when did that happen? And I'm not sure that the rest of the world, at least a lot of people in the rest of the world, actually fully appreciate how that has happened in the flip.
Right, because if you've had any experience with China that predates, I say 2010, mm-hmm. then you were dealing with the early form of industrialization in this industry. You were dealing with primarily state-owned enterprises that were deriving all of their know-how from their Sino-foreign joint ventures, and even most of the Sino-foreign joint ventures were not necessarily practicing, I'd say, forward progressive business models in China. They were bringing what they did globally to China.
Yeah.
Basically a hardware-centric business, with a traditional, B2C, OEM to dealer to customer business model. That began to change, I'd say, in the late 2000s, right? Close to 2010. I think, certain events like the entry of BYD into the automotive, they had, probably been known as a sort of a copycat of Toyota automaker. But what people didn't see was the battery company evolving into a new vertical, automotive, anticipating that the automotive industry would be the big scaling vertical for battery technology. Mm-hmm. Warren Buffett certainly saw that. They invested in that company in the late period, anticipating that this company could be a disruptor. And nobody at that point, even Tesla, didn't really have a proven model for commercialization of electric mobility. Yeah. But sometime around 2010, Uber was born internationally, and eventually the problem of how mobility was being solved was disintermediated by app and internet-based platforms. And really the entry and this disintermediation of digital economy really took off in China in the 2012, 2004 to 15 timeframe, when Didi Chuxing and Kuaidi, Didi Dacho, Kuaidi Dacho, these were two different taxi hailing apps that were created by Tencent and Alibaba. That brought the digital, you know, we don't see it today because it's 10 years later, but that brought the digital economy and a new breed of competitor into the automotive problems, into the mobility problem solving. And that was really an entry point for these companies to not just provide ride hailing, but also see the automotive industry as an addressable market for a portfolio of mobility related solutions. And since that time, you've had the creation of companies like NIO, Xiaopeng. By the way, Xiaopeng, a product of the Alibaba investment, NIO, a product of Tencent investment. You now have Baidu collaborating with another disruptive company, Geely, creating their own brand called Jidu. You have Geely, who acquired Volvo in 2009, now demonstrating that they can be a world's leading automotive enterprise, including electric vehicles, including full-size trucks. So, you know, in this period of the last dozen years, 2010 to 2023, I guess it's the 13th year now, China has really pivoted away from being dominated and driven by state-owned institutions to really private-owned, more disruptive companies backed by deep-pocketed investors with a very, very strong orientation, because it is the world's largest digital economy, a strong orientation toward digital technology.
Mhm.
And that's something you don't see in the rest of the world. That is
Yeah.
something that you just do not see the equivalent of in the rest of the world.
Yeah. So the business model itself, the background of the companies that are playing in this space, all of that contributes to this surge of China's role in the global mobility or automotive markets. I guess there are other factors too, of course. I mean, the very fact that electric vehicles are built differently, the fact that they play the manufacturing and the design of those vehicles plays to the strength of China's existing manufacturing capabilities, presumably, is a big factor. Also, the fact that they rely on batteries, which China dominates just generally as a manufacturing base, not just for cars, but for consumer electronics. Maybe you can talk about all those other factors that make for China this juggernaut when it comes to the
Right.
automotive industry, and how that's playing out. Because as I read recently, China has now become a huge exporter of EVs now to different parts of the world, or it's becoming.
Absolutely, absolutely. And has a natural, I like to say, what happened in China is not going to stay in China, unlike Las Vegas.
Right.
Why? Because what happens in China is saleable to the rest of the world. The benefits of the scale of China working to lower the unit cost, unit margin, per unit
Right.
margin of the vehicles produced. Why? Because they can scale the supply chain much more efficiently on a higher addressable market size. For the, you know, take the EV example, 6.9 million EVs sold in China last year. 990,000 sold in the United States. It's a
Right.
7x of
Right.
the US. It's more than double. Europe was about 2.5, more than double Europe. US and Europe combined don't equal China by a
Right.
factor of, you know, almost 2. So you've got a sizable gap between China and the rest of the world in its ability to scale the demand. First of all, you know, you have to look at this along the value chain: upstream, midstream, downstream. Let's look at the downstream mobility demand. It's far more diverse. Not as many people own cars as who ride in vehicles. So you've got a large addressable market for mobility, not just owned, but shared. That's disruptive. Why? Because it, as I said earlier, it brings the digital economy in to provide mobility on demand at a scale far greater than exists anywhere else in the world. A lot of that shared economy is investing in automotive technology, both for ownership as well as for usership. And usership can scale, was originally the scale mechanism for EVs, because a lot of the initial EVs were sold into ride hailing fleets, Why? Because you reduce the cost of operation of a vehicle powered by a battery versus one that consumes fuel.
Yeah.
If you use a car more, you can lower the cost of operation of the vehicle as a services platform. So actually started with that. And now it's pivoted to a retail consumer demand. Why? Because China as a market invests in infrastructure before other markets do. And it's much more convenient if you do own an EV to get it charged. You de-risk the purchaser from having the concern over range anxiety and how to use the vehicle. So it's downstream demand economy, far more experimental and less deeply rooted. You know, got consumers who haven't been buying cars for very long and are very open-minded toward new things when they do come along, and very technology savvy in terms of their willingness to experiment with technology-oriented solutions, which an EV is. Now you bring in, you know, companies that are very comfortable with a software-defined, digital device-oriented business model, seeing the car as a device that could be monetized, not just when sold, but when it's being put into a day-to-day usage. Consumers in vehicles, streaming data, being able to shop, use the user interface to do things more than just go from A to B. So you've got all that working on the demand side. Now you take the largest car market, that's the midstream, the automotive OEMs, the largest car market in the world, right? The ability to aggregate demand for these mobility devices at a scale far greater than any other. What happens when you can generate scale? You can lower the cost of the goods that are sold, right? And that's what we've seen with EVs. You've got OEMs that made intelligent choices. They didn't target, like we did in the West, premium starting point for EVs. The way the West commercialized EV is they said, aim for the premium, because the cost, the assumption made, was the cost of the EV was going to be higher at low scale. So produce a vehicle, target a premium price point, sell it alongside a traditional car that's going to be cheaper. So you basically influence the consumer to buy the ICE because you're trying to sell it in competition with the EV, right? And that made it harder to sell the EV. So OEMs globally chose a higher price premium. They chose performance as the way to differentiate EV. They used NCM, nickel, cobalt, manganese, as the preferred battery chemistry for the initial vehicles that they built. They didn't do that in China. They chose lithium iron phosphate, cheaper to produce, not as high performance, but more affordable, which is the target market if you're trying to scale a new technology. So they made intelligent choices in the midstream. And if you go upstream at battery, China's the dominant player on battery supply chain. Far, far bigger companies. 6 of the top 10 EV battery OEMs are Chinese. And if you go upstream from that, at the materials processing of graphite or the anode material, of all of the components that go into the battery, China dominates the supply chain for the EV battery materials.
Yeah, well, that's a lot to digest, but incredibly interesting. So let's talk a little bit about some of the changes that have been or are happening now with this market globally, because you know there's so many moving pieces. You know, China just come out of zero COVID policy, as we all know, and you know I'm sitting here in Shanghai, only a month or two after the big change, and you know China's already pretty much back to normal. That presumably has had a huge beneficial impact on supply chain. You know, the scuttlebutt is China is now back to exporting, you know, better than it, you know, last year was a bad year for China exports, but this year is going to be a lot better. At the same time, the US has passed all these industrial policy measures, 3 acts that are, some of which are directly targeting the automotive manufacturing and battery markets, trying to catch up and compete with China in these areas. Presumably, you've got all these giant global automotive companies that are trying to navigate these different trends. China being a competitor, China being a market, the U.S. government trying to steer people towards the US and away from China, perhaps. And then you got Europeans that are kind of caught in the middle, maybe. So can you talk a little bit about how companies and the industry are dealing with these massive macro changes that are happening?
Yeah, well, I think, for a long time, I think that for doing business as a foreign company in China, having to navigate regulations that were not designed to benefit they were designed to develop an industry and to make that industry in China a global competitor, right? Obviously, it was to also have a social benefit for the uh, people in China to be employed by an industry that can drive innovation, drive manufacturing industry jobs. I mean, create a whole supply chain and industrial base around the automotive industry was a smart strategic move in the early part of this, late part of the 20th century, early part of the 21st. But what the rest of the world didn't bargain for was that it was going to eventually supersede the rest of the world in terms of its scale benefits. The supply aggregation benefit of China was a benefit to the whole industry. On the demand side, it was growth, right? You came to China to grow your business. All of the global auto industry has benefited from that for many years, for many decades now, in that China provided virtually all of the growth of this industry over perhaps a 30-year period from the mid 1990s till today, till present day. Having that kind of market working for you, providing profits and unit growth, you then have the benefit of scaling your supply chain around this market, which, as a strategic move, probably the low-cost country sourcing paradigm of the late 20th century, early 21st, actually had a long-term detrimental impact in creating an over-reliance on China, which we paid for by a self-inflicted cost penalty from the trade war, which was actually launched pre-COVID in 2019, to now the current situation where we have seen the impact of the pandemic and how it's disrupted supply chains and made it more difficult to get the efficiencies that came from the globalization of the automotive industry supply chain. I would say China played a smart game of industrial policy and leveraging public and private partnership to effectively tilt the playing field in favor of China for being the place to buy the critical components needed to make not just EVs, but any component of a vehicle, right? Anything you need to make, you can make it at greater scale, cheaper in a market like China, not because of low labor cost anymore, but because you've got the benefit of the huge economy of scale working for you and the efficient supply chains that have been built. And that was done with a whole lot of, planning in anticipation that China would become the factory for the world's automotive industry component technologies. The risk now is that in the EV era, with China scaling much more rapidly than the rest of the world, it won't just be adding China to the global supply chain that existed to the rest of the world. It is the supply chain for batteries. It has become the place that you inevitably, if you're building an EV, are going to need the components that come from China, in particular the batteries, or you're going to need the Chinese battery companies or to invest in building capacities in Europe or in North America in order to get the efficiency working for the local companies. The push the industry is moving toward is more vertical integration and more regionalization of supply chains. That is not necessarily going to work to the consumer's benefit. A regionalized supply chain does not have the same scale benefit to the consumer, which means we're probably going to be paying more for the products that we consume.
So how do you evaluate the likely effectiveness of these new U.S. industrial policies on encouraging U.S. and other companies to set up competitive battery and other supply chains in the U.S.?
Well, necessary, but probably not sufficient to change consumer behavior. A supply chain, this push if you can encourage investment, which you should, in building up local capacities. I mean, the U.S. has to be in the game,
Yeah.
and being too dependent on China is not a good thing strategically. The U.S. dominated the energy supply chain. This people, let's not mistake, the intense here. This was a smart game played by China, but it wasn't for the end game of being the dominant EV market, which it has become. But the real game was to create energy independence and create energy security for China. And being dependent on ICE technology was not only bad for the automotive enterprises in China, but it was also encouraging a carbon-based energy supply chain dependence, which was not working to the advantage of China. So the pivot to EV is as much an energy security play as it is an industrial policy to drive a more ascendant Chinese EV automotive industry. It's done that, but I think it was primarily motivated by creating a more secured supply chain around the components that were being served into the transportation sector, and they've achieved that. They have achieved that. The question then is, can the United States or can the West rely on, unlike the carbon-based economy, which was dominated by the Western economies, plus Russia, can the rest of the world rely on an energy supply chain for transportation sourced from China? The conclusion of that has to be no. You have to have regionalized control, and that's what the Inflation Reduction Act, the and the other recent policies have been encouraging companies to do. The flaw in the argument, though, is that it's actually not necessarily creating domestic champions in the regions. What it is doing is it's accelerating the globalization of the East Asia region, because it's the East Asia battery pack makers and their supply chains that will ultimately need to come to the US and build their factories. Ford just announced a partnership. They were intending to go to Virginia. Now they're going to go to Michigan with CATL. You're going to have BYD or Goshen also building a factory in Michigan. You're going to have a whole lot of East Asia, inclusive of Korea and Japan, companies building more and more capacities for the EV supply chain in North America. So it's actually not necessarily working to the benefit principally of the companies from the region, but it is encouraging those companies from the world to come to the North American region or into the United States to invest. It's another form of globalization in reverse. In that sense, it's actually probably a good thing.
So we're running short on time here, Bill, and I don't want to take up too much of your time. But one last question, kind of big picture question for you, which is, because I know you consult with a lot of different companies, both Chinese and international, and East Asian or whatever, and so you see the landscape as it's moving. You have these, as we talked earlier, these tectonic factors about both decoupling and conflicts between the U.S. and China. You have China's growth, the rise of China's competitors and EV companies of different types. You have what is probably one of the biggest disruptions of the major industry in history happening before our very eyes, right? And right. Whether it's to traditional car maker OEMs, or it's to energy companies or whatever, right? So how do you see these, especially the Western manufacturers, how do you see them rejiggering their strategy? Because they've always held China as being a very strong and important market. Many of them had most of their profits coming out of China. Right. And then suddenly they view China as maybe more of a competitive threat. The market may be more difficult for them because the competition is stronger. Even Tesla is seeing headwinds here. And then China is invading their own home turf in some cases, although probably not so much in the US, but maybe more in
Right.
Europe. So how's that going to play out?
Well, it's going to be a vastly different competitive landscape. It's already clearly going to be a very different supply chain. Incumbency does not guarantee anything
Yeah,
in the future of mobility. In fact, it guarantees one thing, slowness. It guarantees, why? Because these legacy companies have a carryover bias, right?
right,
They're slow by nature. They only invest when they de-risk the financial forecast for their business plan, which means they don't take high odds bets. Uh, the backing of venture capital, especially now post the EV apocalypse, a lot of the SPAC list, the bad taste in the mouth of the investment community toward the first wave of excitement around electrification led to funding a whole lot of pre-revenue companies, which we've now we've now created a mentality of de-risking venture investment in the West. That hasn't gone away in China. China, again, is partly public-private partnership. The government de-risks, the government invests in infrastructure. You've got digital ecosystem companies which are acting as the shock absorber for risk. They're acting as the early stage investor. I mean, Geely and Zeekr just raised like a multi-billion-dollar A round, right? Who does that internationally for a new EV company? Why? Because you've got Chinese ecosystems with government as well as private industry coming in and digital economy coming in to de-risk investment. So if we're going to compete in the future of mobility, we need this ecosystem mindset. We need government support. We need private industry support to act as the shock absorber for more experimentation. But I don't think traditional automakers are given any advantage of incumbency in this new future automobility value chain.
right. Well, if nothing else, it's going to be an exciting and interesting time that we're going to live in for the next few years as this industry kind of disrupts. So fantastic insights, Bill, as usual. Look forward to having you and your comments at our event in Bonnie Doon on April the 20th, whether online or in person. And again, it's always a pleasure to talk to you.
Thanks again, Howard.
Okay, excellent.